Ever stared at a TradingView chart, a sea of lines and colors, and wondered which single tool holds the key to unlocking consistent profits? You're not alone. Traders of all levels constantly search for that one magic indicator, the holy grail that will flawlessly predict market movements. But what if I told you the answer isn't as straightforward as you might think? Think about it. The market is a complex beast, influenced by countless factors: economic news, global events, investor sentiment, and even a little bit of herd mentality. Can one single mathematical calculation truly capture all that nuance and give you a crystal clear buy or sell signal every single time? The truth is, the most powerful indicator is a bit of a myth. No single indicator works perfectly in all market conditions. What might be incredibly effective during a strong uptrend could give you false signals during a period of consolidation or high volatility. Relying solely on one indicator is like trying to navigate a dense forest with only a compass pointing north. It gives you a direction, but it doesn't tell you about the obstacles in your path. However, that doesn't mean indicators are useless. Far from it. They are powerful tools when used correctly, providing valuable insights into price action, momentum, volatility, and potential trend changes. The key lies not in finding the single most powerful indicator, but in understanding how different indicators work and how they can be used together to form a robust trading strategy. So, instead of chasing the elusive Holy Grail, let's shift our focus to understanding the strengths and weaknesses of some popular indicators on TradingView. Take, for example, moving averages. Simple yet effective, they smooth out price data to help you identify the underlying trend. A rising moving average suggests an uptrend, while a falling one indicates a downtrend. Crossovers of different moving averages can also generate potential buy or sell signals. However, moving averages lag price action, meaning they might not be the best for catching very short-term moves. Then there's the Relative Strength Index, or RSI. This momentum oscillator helps you gauge whether an asset is overbought or oversold by measuring the speed and change of price movements. Readings above 70 often suggest an overbought condition, potentially signaling a reversal, while readings below 30 might indicate an oversold condition. However, in strong trending markets, the RSI can remain in overbought or oversold territory for extended periods, giving false reversal signals. Another popular category is volume-based indicators. Volume provides crucial information about the strength behind price movements. Indicators like unbalanced volume, OBV, and volume price trend, VPT, can help you confirm trends and identify potential divergences between price and volume, which might foreshadow a trend reversal. However, volume data can sometimes be noisy and difficult to interpret in isolation. Ultimately, the most powerful approach in TradingView isn't about finding one superior indicator, but about building a confluence of evidence using multiple indicators that complement each other. By combining indicators that analyze different aspects of price action, trend, momentum, volatility, and volume, you can filter out noise and increase the probability of your trading signals. Experiment with different combinations of indicators on TradingView. Backtest your strategies on historical data to see how they would have performed. Understand the limitations of each tool and learn to interpret their signals within the broader market context. The real power lies not in a single indicator, but in your ability to analyze the market using a well-rounded approach. With that said, thanks for watching, and until next time.